Good morning. Welcome to Stock Market Today for Wednesday, June 3rd, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. That hits your inbox every trading day before the market opens. So U.S. equities were higher in Tuesday's trading, finishing near the best levels of the day. As the cyclical sectors once again outperforming, energy, materials, and industrials led the charge. Staples and comm services lagged, though I do note that all sectors were higher on the day. Treasuries were weaker with the curve steepening. Dollar was much stronger against the yen, right? That's a risk-on type trade, but it lagged against the euro and sterling as it's been doing for the past week and a half or so. Gold finished down 90 basis points, and the miners came under pressure. WTI crude closed higher by nearly 4%. As we get to the desk this morning, a little bit of a continuation with futures up about 40 basis points following a bullish session in Asia overnight. European markets are moving higher as well, some of them solidly so. Treasuries are weaker with the curve steepening once again. The dollar stronger against the yen and risk on. But extending its recent pullback against both the euro and sterling. Gold is down 60 basis points. Crude oil is up 1.5% to get us going on a Wednesday morning that followed a Tuesday where the grind higher continued. Right, ever since breaking through that key 3,000 mark and the 200-day moving average, S&P 500's kind of been doing this slow grind higher, right, towards that resistance zone near 3110 that we've been talking about. A break of that resistance area would target the highs, right? That would open the door for an attack on the highs. On the downside, should we begin to fade, 2850 to 2950 is the initial support level that we are focused on. That's these gaps here and here. Below that, 2750 starts to come into play. Although I wouldn't be surprised to see some resistance or some fight rather here at the rising 50-day moving average. We are overbought in the near term. We're very close to overbought levels. Chaikin money flow is flat to bullish over the past couple of weeks. Let's give it a bullish bias here in the near term as it's been choppy back and forth above and below the zero line. So that's the framework that we are working with as we head into a Wednesday morning where we're seeing increasing signs of that rotation. And we're going to talk about that a little bit later on in the show. As we talk about our market in a minute, though, what am I writing about today? Well, the grind higher was led by small caps and the Dow, right? That's the rotation, right? Dow and the industrials, the kind of stodgier old economy type names. And small caps, which had been big underperformers for the past couple of years, starting to see some bullish rotation. Now, the data points are lining up, but something we're going to continue to watch and focus on because the similar rotation played out in the fourth quarter of last year, and it turned on a dime as soon as the calendar flipped. So just something we're keeping an eye on. But right now, the data points continue to point towards that rotation. Major market ETFs are all now in overbought conditions. That's based on our overbought oversold indicator. And that's as sentiment moves further into a position of greed. We'll take a look at that a little bit later on. Strength in Germany is another one of those added positive data points for the rotation trade. And futures, as I said, point to a higher open here today. Let's look at the major indices now. The Dow outperformed yesterday, tacked on a little over 1%. Power bar ratio improved slightly, but is still bearish at 4 to 9. The S&P 500 up 80 basis points, 97 to 99. That power bar ratio continuing to improve as it gets closer to an even position. NASDAQ was a slight underperformer, but still greater than 3 to 1 bulls to bears for the NASDAQ. Small caps, they were an inline performer yesterday, 542 bulls, 270 bears there. Bonds downtick. And what we're seeing in the bond market is a steepening trade going on, where longer-term rates are rising faster than shorter-term rates, causing the curve to steepen. That's a data point towards the rotation trade, should that continue to play out. Another one is energy, which has been strong of late, up 2.8%, but still no bulls for 21 bears in that sector. So basically, from a power bar perspective, small, more bullish than large. Major indices across the board are mixed. Going to hit our stock of the day now because this is one that's interesting to me, and I'll kind of in full disclosure say I do own it. 2U. 2U is a company that focuses on online education, and they are partnered with some of the most well-known universities in the country, in the United States. Stock has a bullish rating, strong trend above that rising long-term trend line, and in a strong industry group, right? You can see it here, bullish rating, outperforming the market, has now just entered an oversold position with bullish money flow to trigger an oversold buy signal. So I gave you the checklist here, type of name you want to own, certainly, right? Bullish, outperforming, and in a strong industry group. From a timing perspective, when do you want to own them? You want to own stocks that are oversold within the context of an uptrend while it's under accumulation. Now, what you'll see here is the overbought oversold indicator says early, right? And that's because we are oversold, but the indicator is still heading lower. We think a more optimal opportunity is when that overbought oversold indicator begins to turn higher within the context of an oversold position. You can see examples of that down here. You can see another example back here where the indicator, when you first get into that oversold position, you can still head lower for a few days. It's when that indicator starts to begin higher that we think it's a higher probability trade. But I wanted to flag it today because I think that this is an interesting name that is never mentioned in the COVID stocks, right? Everybody likes to talk about the DocuSigns and the Zooms of the world. But as you drill down and do more work, this is a name that I think is a beneficiary of some of the shifts that could come out of COVID-19. As obviously I believe in it, I'm an owner. And I'm highlighting it here for you today. Take a look at 2U as a bullish opportunity. Let's look at our sector tracker now, the movement of the major sectors over the last 5 days. Kind of interesting with the utilities at the top of the list as the market grinds higher. That is a defensive trade. I can make the case that, real estate, while traditionally defensive, is more of a rebound trade and a reopening trade. I would lump that in with the casinos, the cruise lines, and some of the retailers at this stage of the game. But utilities at the top of the list is worth taking note of, especially with major markets overbought here in the near term. Materials, that's your reflation trade. Financials, again, part of your rotation trade. Staples, industrials, healthcare, and discretionary are middle of the road. Tech, energy, and comms, bottom of the list. But all of the major sectors are higher over the last 5 days as the market grinds through that key 3,000 mark on its way to 3110 that we have been highlighting. Let's turn to our industry in focus now. It's the Dow Jones REIT Services, speaking of real estate. And it's been a mess over the past 6 months. There's no denying it. Hard hit area of the market as people try to suss out what the COVID-19 pandemic and its aftermath mean for both commercial and residential real estate. REIT Services lagging the S&P by 21% over the past 6 months and has a weak power bar ratio, 14 bulls to 19 bears, currently ranked number 15. Of the 21 subsectors that we track. It's moved up 4 slots over the past week, given some of the improvement here that we've seen in the group as a whole. But the names there that are very bearish are Apartment Investments, AIV, Universal Health, UHT, and Essex Property Trust, ESS, all with very bearish Chaikin power gauge ratings. And as we look at the fund RWR, this is the Spider Dow Jones REIT ETF. We can see the bearish rating and the weak trend below the declining trend line that I've kind of obstructed here with my trend line. So what do I see? I see a bearish fund underperforming the market with bearish money flow that's now overbought. Now, the more aggressive types who want to say, the market's going higher and these names have been beaten down and I want to focus on the beaten down areas of the market. There are plenty of people who invest that way. If you're on the aggressive side of that argument, this is the trend line you care about. The broken triangle here to the upside. If you want to be a little bit more conservative and give this more time to play out, you could be focused on these April highs that line up with our long-term trend line, and a break of that would certainly go a long way towards changing this weak trend and working higher in the near term. So a couple of ways to look at it, and I just wanted to frame it up. For me in my process, I'm not there yet. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers. Western Union up 11.3% on news that they might buy out MGI. Services were strong yesterday, helping DXC up 9.5%. EFX said that they were going to provide an update. That's on the update will take place on the 8th of June. That sent the stock higher. Gap, soft lines were strong yesterday. Again, rotation, reopening, call it what you want. Helmerich and Payne up 7.5%. Oil levered name, still very bearish, nothing company specific on that side of the board. Tiffany's kind of interesting. Stock down nearly 9% yesterday. Remember, they are in an agreement to be bought. And there was an article in Women's Wear Daily kind of calling into question the deal or the deal in its current form, given everything that's gone on with COVID, right? You enter into these deals, but generally speaking, there could be clauses in there such that if there's a material event, the deal can be renegotiated. Women's Wear Daily was opining on that yesterday, which sent Tiffany lower. Newmont was down with gold. MSCI, one of the larger growth stocks of late, is seeing some profit taking, down 3%. Software was weak, which weighed on Norton LifeLock, and didn't see anything really company specific to drive Win lower by 2.74%. Let's dive into the charts now, right? On Wednesdays, I do sentiment. Take a look at whether investors are too greedy, too fearful, or somewhere in between. And I would argue that we have quickly shifted back to the too greedy camp. This is the 13-period moving average of the CBOE equity put call ratio, right? Back in January, February, the exuberance about the new year, the new decade, market moving to new highs, investors got fairly greedy, right? Pushing this ratio or the moving average of the ratio down to about 0.5. And then COVID and everything that followed sent fear to an extreme level. And now the market bottoms in March, right here, and we start to head lower. We are now back towards the excessive greed areas that were in place when the market topped out back in January. Now, that's interesting in and of itself, but also all the more interesting as it coincides with near-term overbought conditions for the SPY, the Qs, and the IWM. And you can see how it's taken place here within the context of the move in the S&P 500, right? Sentiment is one of those data points that makes sense to pay attention to at the extremes. I do think it makes sense to be paying attention to it here. Is it a guarantee that the market is just going to tank the way it did? No, but I think it's an opportunity to temper or reevaluate your levels of aggression on the long side of the portfolio here in the near term. So sentiment by this metric certainly much more greedy than fearful. I said we would talk about the data points around rotation, right? One of the data points I mentioned earlier was the steepening of the yield curve. Another one that I think makes sense to pay attention to is what's going on in Germany, using that as a proxy for Europe. And I realize that that's a little bit of a blunt instrument, but if Germany is kind of the economic power of Europe, as Germany goes, much of Europe is going to go the same way. And what's interesting is that Europe has been an absolute mess for a long time. And if you kind of believe in this rotation trade that's playing out here in the US, that's playing out in commodities, that's actually playing out in currencies as well as interest rates, as I mentioned, with the curve steepening, Germany would be a positive data point there. And if you were playing along with that trend, if you were looking at, say, the materials, which we've been highlighting over the past couple of weeks, you'd want to continue to see Germany doing well. And you'd want to see, you basically want to see similar activity to what you're seeing in the US. Take out the 200-day moving average and continue to grind higher, right? Close the gap, attack the highs. That would be constructive. If Germany started to roll over from here, I would, in conjunction with other data points, I'd start to question that trade. Speaking of other data points, here's your 10-year yield, right? So if that rotation trade is real, we would expect rates to continue to move higher. 10-year is drifting higher, but still very much in this consolidation. With room kind of to the downtrend line within this triangle. I personally, longer term, still see scope for yields to move lower, much longer term. But in the near term here, there's certainly room for rates to continue to back up. So depending on your time frame, That's kind of the framework that I'm using here as I suss out what's going on with this rotation trade. That's going to wrap us up for today. Head over to chaikinanalytics.com/test drive. Sign up for a free 14-day trial. And I will be back here with you tomorrow. Have a great Wednesday, everyone.